I'm Charlotte McLeod with investingnews.com, and here today with me is Don Durrett of goldstockdata.com. Thank you so much for being here. Always great to be catching up with you.
Yeah, I've been doing these for a few years with you. Seems like the people that follow us, they get another update.
Yes, I think everybody always enjoys when you come on. So excited for this conversation. And our last talk was all the way back in January when we were here in Vancouver at VRIC. So I think it's safe to say quite a bit has changed since then. And I want to start with gold, of course. You really emphasized at that time, as well as in previous conversations, that if we want to know what's happening with gold, we have to take a look at the bond market. So I wondered if we could take a look at gold's price activity the last couple of months since we talked in that context.
I firmly believe that the reason gold took off in February 24. So in February 24, gold was at $2,000, and then it just took off. And then the reason why I believe it took off is because of the Ukraine war that started 2 years, February, March before that. So it basically took 2 years, and that war didn't end. And so that war created geopolitical friction that was already building. We already had this economic Cold War between the U.S. and China. And it's basically, a battle over who kind of controls the global international trade and the currencies and the interest rates. And the U.S. has been in a dominant position since the end of World War II, where we've been exporting our bonds to the rest of the world, and the rest of the world's been buying them and turning around and buying our debt, buying our assets, buying stocks and bonds and companies and whatever, rotating money back in. So we've been dependent on that rotation, that flow, if you will. American consumers will buy your goods, then you buy our debt, and it flows around. Well, that war kind of signaled the end of that. And so it created a lot of uncertainty. And so we got 2 years, the war didn't end. And so since the war didn't end, the SWIFT system that's how international trade, commerce, that's how all of transactions were done, through the SWIFT system, which is only using the US dollar. And the whole world was using that system. And suddenly Russia was kicked out of that system. And I think when Russia got kicked out of the system, China recognized an opportunity to create an alternative system to SWIFT, which I think they wanted. And they're like, oh, this is our opportunity. Normally, China and Russia should be antagonistic towards each other because they're both in the same area of the world, in Asia, and you can only usually have one dominant player. So they're like natural enemies. And India is an up-and-comer as well. They're a very large country. As a matter of fact, demographics show that India is going to have a bigger population than China very soon. So India is a player, and so they're antagonistic. So you have these three antagonists who all of a sudden became friends because of the war in Ukraine. And that created a situation where the U.S. bond market suddenly became a little bit fragile because we're starting to lose our customers. We're starting to lose kind of the status quo. The status quo started to break down. And I believe that's the reason why gold started going up in 24. And it's been basically going up nonstop. And this is where I say that the bond market is so important to gold. And this is why I say the only reason I own gold and silver mining stocks is because I believe that the U.S. bond market is going to fail. Now, I don't need it to fail for the gold and silver mining stocks and for gold and silver to go up. All I need is for it to become fragile. And once it becomes fragile, then people start to become a little nervous. They're like, I don't want to own these bonds. I don't want to buy these bonds. I'm going to sell these bonds. And I think that is the era we're heading into right now, is fragility in the bond market. All it's going to take is a recession in the U.S., which I think is coming. We can talk about that. But I think gold in the bond market is really, that relationship is the key to it all. And that's the reason I own gold and silver mining stocks, because I just feel that we're in an untenable situation. Everything was working fine until a few years ago. And then the U.S. debt problem, it started growing to a point where it becomes untenable, where now, the weakness in our system is interest rates. As long as interest rates were down at 1%, we were okay. We had like $200 billion interest payment, we could handle that. Now it's at $1 trillion and interest rates aren't going down, and we can't cut the budget. Doge cut it by $200 billion and it was a joke, right? It was like, that didn't do anything. It was like, did that reduce the deficit? No, it didn't. And then now Doge went away and now we're back to 2 trillion. So they tried and they failed. And I don't think there's any solution here.
I think this is a great direction to go on. Maybe we talk a little bit more about your U.S. economic outlook, because I know people have a lot of questions about that right now, especially given the Iran war and the inflationary impact that we are starting to see play out. So U.S. economic outlook, how are you seeing that right now?
Yeah, I think this is really important. I think that most people kind of believe the narrative, and the narrative is that earnings are strong and they are double digits. But if you separate out the Mag 7, and the Mag 7 haven't been doing great lately. I mean, if you look at their stocks, although we had a bit of a rebound this week, the Mag 7 has really been holding everything up. It's not as if we have strong earnings across the board. So that's a positive. The other one is that the stock market has been resilient. But the thing about the stock market is not an indicator of the future. Stock markets tend to fail at the top of markets. The 1929 crash, the 2000 crash, the 2008 crash. These crashes tend to happen at tops when nobody's expecting them. So the stock market is not a good indicator. And the last positive really for the stock market is an injection of money, QE, by the Fed. So the Fed is printing money and injecting money and kind of keeping it liquid. And everybody kind of believes that as long as they do that, everything is fine. But okay, so those are the three kind of things that you can look at it that are positive, that are going to prevent a crash or prevent a recession. But then if you start looking at all of the negatives, which Wall Street doesn't want to look at, the list is really, really long, especially from a historical standpoint. So the first one is the debt bubble. So the debt bubble, we're all aware of this, $39 trillion national debt, but that's only kind of the tip of the iceberg, because then you have consumer debt and then you have business debt, which are also at massive levels. So the debt bubble is not going anywhere. And then in tandem with the debt bubble, you have this fiscal dominant situation where if the government doesn't have high deficits, $2 trillion deficits, then the economy will falter. And that $2 trillion of deficits is actually counted as part of GDP, which is kind of insane, because we're printing GDP. It's like a business going out and it doesn't have any revenue, or has a little bit of revenue, and they borrow $1 million and they call that revenue. Oh, we're making profit, right? It's the same type of thing. You can't print GDP, but we do. The other thing is kind of what people don't realize is that we call it consumer spending. 70% of the economy is consumer spending. That's very misleading. When a business spends money, they consider that consumer spending. And when the government gives money to a business, that's considered consumer spending. So a large chunk of this so-called 70% consumer spending is not me and you spending money. It's a very misleading thing if you do some research on that, what they actually count consumer spending. I talked earlier about the fragility of the bond market. I talked about geopolitical problems. Those are headwinds for the U.S. economy, in my opinion. Tariffs haven't gone away. Tariffs are impacting the economy in a negative way. They're basically a tax. Inflation hasn't gone away. As a matter of fact, inflation is picking up steam right now. It's increasing. The last reading last week was 3%. 3% is high. We consider high inflation. We're at 3. We're basically have a 3% floor right now, and it's going up. Cost of living. I would submit that 50% of the families can't pay their bills. the stock market being overvalued, that's usually when you get a crash. And the stock market is clearly overvalued. I mean, if you look at the Buffett indicator, it's 200% of GDP, all-time highs. Dave Collum thinks it's 200% overvalued and it has to go to the mean. I think he's about right. De-dollarization. So you have foreign countries who are switching out of using U.S. bonds as reserves into gold. That's a trend that's happening, and that's basically negative for the U.S. economy. The employment has been dropping since last year. And right now, if you lose your job, it's probably going to take 6 months to replace it. That's not what we normally see in a strong economy. And I think the employment is getting worse. Housing, the average house right now is about, in the U.S., is about 450,000 for both existing homes and new homes. And when you put a 6% interest rate on that, the affordability on housing is really bad. As a matter of fact, in March, sales of existing houses was the second worst on record. The worst was in March of 2009. And so existing home sales has been drying up and inventory has been going up. Housing, I mean, that's a weakness, right? The economy. So if we look at weaknesses, the list just gets longer and longer. Autos. If you go to buy a car right now, you're lucky if you get an 8% interest rate. Well, 8% on $50,000 is a lot of money. That's a lot of interest on an annual basis. So that's bad. ISM numbers. Yeah, they're over 50 right now, but they've been going a lot like Japan in the early 1990s. They go positive, and then the next month they go negative. Positive, negative. But we haven't seen 3 months in a row of positive numbers in the ISMs, and I don't think we will. Office vacancies. This started in COVID, but it's never came back. The vacancy rate for commercial real estate in the downtown cities is at crisis levels, and it's not improving. That's a problem. Banks. So banks had, when interest rates went up, the banks' balance sheets got whacked. Those interest rates are still high, so their balance sheets are still ugly. Plus, we have credit card delinquencies are on the rise. Bankruptcies are on the rise. So there's more weakness there. Private credit, this is a new phenomenon. It just started the last 6 months. Actually, I think in the last 3 months it started, and it just seems to be getting worse. That came out of left field. That's not a nothing burger. AI. I think AI is a jobs killer, right? But right now they're building these data centers. And when you build a data center, it's kind of a one and done thing for your local economy. So all the construction workers, they get paid when they build the data center. But once the data center is done, they got to go find another one to build, right? So they're kind of a one and done thing. So it's kind of it's a fleeting push to the economy. And now you do get some full-time jobs in there, of course, but most of these data centers run on their own. They're just a bunch of computers. And so there are not a lot of jobs inside these data centers. And I think that AI is a jobs killer. If you look at how many jobs have been lost to AI, I think it's going to increase. Walmart, one of the largest employers, just announced that they're looking at AI to replace workers. So look for that to happen this year. Now, Walmart's going to be, instead of adding jobs, going to be reducing jobs. Amazon's already done that. Instead of adding jobs, they're reducing jobs. So these are the largest employers. That's a negative. Demographics. If you look at demographics, in the 1990s, the last time the U.S. really had a strong economy, the demographics were in our favor because the baby boomers were coming into their own. The baby boomers were hitting their maximum revenue, maximum income. Well, that was 30 years ago. Now they're all retiring, when they retire, their income drops dramatically because they no longer get the salaries. Now they trade their $10,000 a year a month for $3,000 from the government, right? For the Social Security, but they don't have the income that they had, and so their spending is going to drop. And that's not a small thing. I mean, if you look at the number of boomers that are retiring on a monthly basis, it's pretty ugly. Healthcare affordability. There's a lot of families out there that they're paying health insurance, but that's squeezing out what other their discretionary income. Healthcare insurance is very high. The political situation. our political situation is probably at the worst ever in the history of the country. The Democrats and the Republicans no longer have the same values. They can't even talk to each other. College cost, very, very high. That's putting a lot of pressure. Whenever you have to buy something that you really can't afford, that's a negative. GDP slowing. GDP was last year was, pretty high. I think it averaged 3% last year, but a lot of that, again, was the government spending. But now it's sub 2%. So it's barely hanging on. And so the last one I'll mention is retail and restaurants. We've seen one chain after another go bankrupt. We know that this economy is not strong. We know it's just hanging on by a thread. We know this. It's basically a big Jenga game, and one more pull out, and the whole thing's going to come falling down. But if you turn on the TV and you watch the cable business channels, you will think that it's 1995 and everything's great.
Absolutely. Absolutely. And I wonder if we can take a closer look at the stock market as well, because again, back when we talked in January, you were saying how maybe this is the year that the bell is rung. And of course, the timing is difficult, but are you feeling that that's coming sooner than later? Do you have any further inclination on timing at this point?
Yeah, my newsletter came out in January 1st. I said that this is the last year of American greatness and that I expected a recession this year. But I also said I expected the second half of the year. So here we are in April, and it's hanging in there. It doesn't look like we're going to have a recession in the first half of the year. But I think it will happen in the second half of the year. And the reason why is because of the midterms. I just feel that the optimism in America, if you will, one of the reasons why we have this optimism is Trump is a pro-business president. He's kind of a low tax, low regulation, I'm going to do whatever it takes to grow the economy attitude. His focus is on the economy. And that has supported the stock market substantially. Well, he's going to be a lame duck if the Democrats win the House in November. And I think there's a very good chance that is going to be the outcome. And so if he loses the House and he becomes a lame duck, at that point, I think business is going to start to get really, really nervous about how late in the cycle we are, how close we are to recession. And then now what? How are we going to avoid this? For instance, if you look at the corporate tax rate, and if you look at the highest rate for consumer individual, I think it's 37% is the highest rate. And then capital gains, 15 and 20 is very low. And so those three rates, the Democrats are going to raise all three of them if they get an opportunity to do it. And so I think that we're going to start to recognize that the economy is slowing, and the Democrats are basically not going to be very helpful in that regard. They're not going to be a pro-business stance at all. They're going to be an anti-business stance, raise taxes, and that's kind of a hopium way, because it's basically saying that if we raise taxes, it won't hurt the economy, but it'll help the budget. So we're basically going to be, this massive deficit. Well, how do we fix the deficit? Well, we're not going to cut spending. We're going to raise taxes. And so I think that people are going to start to see that the direction is towards higher taxes and not lower taxes, that we're in a low tax. This is as low as taxes are going to get. And they're just going to go higher from here. And I think that a lot of confidence is going to be sucked out of the economy between now and the midterms. And once the midterms, I don't know if the crash in the stock market will happen before the midterms or after. Flip a coin there. But I do think the second half of this year, I'm expecting the recession and the stock market to go down. So for me, I think 5,500 is where we basically get a decoupling. So gold and the S&P 500 have been basically, I think, in this battle of who's going to win. They're both basically near all-time highs, although gold's 16% from its all-time high, about 4,850, and its all-time high is 5,600. So it's about 16% away. and the stock market's only 1% away. But every time in the last 2 years, every time gold corrected, it turned around and ripped back for an all-time high, which I think it'll do again. So they're in this battle of who's going to win, who's the winner. Normally, they don't both win. Normally, one does well and the other does poorly. They're cats and dogs. They do not get along. And so which one's going to be the winner? And I think that at 5,500 is the numbers where that's where the battle is going to be fought. So it's going to be 5,500 on the S&P, and we're at 6,900 today, 68, almost 6,900. So it's got a long ways to go all the way down to 5,500. And gold, I think 5,500 on gold, though that's where you're going to get the decoupling. So right when they're both right around 5,500, now we probably are going to see 5,800 on the S&P and 5,000 on gold. So gold will be down and about 600. And then gold will start rallying, and right at 5,500, that's where they'll crisscross. So gold's going to go below 5,500. It already is at 48, but it'll be below 5,500 when this decoupling starts, and the stock market will be above it, and the stock market will go below 55, and gold will go above it. But that's just my kind of line in the sand. That's what I'm looking at as the place where the battle is won by gold is right around 5,500 on the S&P, and I think it'll happen this year.
This is exactly what I was going to ask you about gold in 2026, is how you see the price playing out in conjunction with everything else you've been talking about. So could potentially be this year that we get those new all-time highs in gold, and we see that transition happen with the S&P. Yeah,
absolutely. I think it'll happen this year. I think gold will hit an all-time high, possibly in June, and then have another deep correction all the way down to, we might even go all the way back to 4,100, but 4,100 looks like it probably will hold. Unless the Iran war gets worse. If it gets worse, then we might go back below it. Right now, it looks like 4,100 is going to be the low, but I think we'll go back down to 42 to 4,400. Even if we hit an all-time high, if we go to 5,600 again, I think we could crash all the way back down to sub 4,500. One more deep correction. But the one thing people need to realize is that gold is the asset to own. It's the buy the dip asset. It's going higher. So I don't care how much they try to push this thing down. They just tried to push it to 4,100 like 2 weeks ago, right? We're at 4,850. It went up $750 in a week. So good luck holding gold down. It's not going to happen. That's why I say you want to buy these dips, because gold is the buy the dip asset. The only way that gold is going to get pushed down and held down and kept down is if the U.S. economy comes roaring back to life. And I just gave you that long list of problems that we have to fix. I mean, good luck with that.
Yeah, good luck. And I want to talk about silver as well. I think previously you'd said, well, silver's along for the ride with gold. So if gold is going higher, silver is going to follow. Does that still hold true if we have economic troubles? Because silver, of course, it's got its investment side, it's got its industrial side that could maybe potentially be hurt. So what are your thoughts there?
So gold is very easy to understand. 80% of gold is investing gold or jewelry, which is basically the same thing. And so gold is really easy to understand. It's just an asset, it's a store of value asset. End of story. Simple story to understand. Silver is, I consider gold a man. It's ruled by the sun. It's very masculine. It's very stable. Leo is the astrological sign that ruled by the sun as well. It's also ruled by gold. Gold is the stable masculine sign. Silver is the feminine sign. It's ruled by the moon. The moon is always the maternal moon. It's always the feminine. You can't understand silver. It's very volatile, and when you buy, you just don't know what's going to happen with silver. Silver right now, gold's down 16%. This is the thing that cracks me up, how you can't understand silver. Gold's is 16% away from its all-time high. Guess, I'm going to let you guess because you won't even come close. Guess, you might get it. Guess what the percentage is that gold has to rise to get back to its all-time high. Gold only has to go up 16. So what do you think silver has to do?
Oh, to get back to the all-time high, 40%?
50.
Oh my goodness.
Yeah, it's at 79 right now. Call it 80. It's got to go to 120. It's got to rise 50% to get back to its all-time high. That's how volatile silver can be. And so silver, you can't understand it. We don't know it up and down. When it runs, it really runs, right? It went from 35 to 65 in a few months, over 100% move. So silver, we don't understand. Silver has so many issues, if you will. One, not only is it an industrial metal that needs about 70% of its supply needs to be done by fabricators, but it's also a critical mineral. I mean, gold isn't even close to a critical mineral, right? Silver's a critical mineral. And there's not enough of it. If you look at above ground supplies, as a matter of fact, right now the COMEX has like 80 million ounces in registered. 80 million. I mean, they're running out real fast. They're going to have to come up with some silver here this year. They're going to run out. I mean, if you look at the inventory levels, the LBMA and the Shanghai, those are the only three places where you can buy silver. And right now, over 200 million ounces a year is needed just for solar alone. And if you look at vehicles on top of that, you get to 300 million. All the vehicles, including airplanes, anything with a wheel on it basically needs silver. Anything, all your appliances, all your phones, they all use silver. So it's easy so we could run out of silver. Okay, if we run out of silver, then what? We don't know. It's uncertainty, right? What does the government do? Do they prevent us from buying silver? Do they tax it? What do they do? We don't know. There's lots of uncertainty around silver. And so in theory, silver should just absolutely go to the moon in theory, because there's not enough of it. And if gold goes higher, silver's going to follow, which I've been saying. I'm confident that silver will follow gold, but there will be periods. This is important. There will be periods when silver does stuff that we just shake our head and go, what the hell's going on? And what I mean that is that like silver could go to 150, 180, and then turn around and go all the way back down to $80 and stay there for 3 months. I mean, we could see crazy stuff like that. Now, why would silver do that? It would be because the government put some regulations on. But anything that the government does will be a one and done thing. They won't be able to do it permanently because it's global. It's global in nature. So anything like the West does, they can't put that pressure on China and India. China and India, they're going to keep buying silver, period. But the U.S. can try to control the inventory levels. One of the things I think the low-hanging fruit is they can empty the ETFs. And that's an easy one, but it's a one and done thing. Once they do it, then once that inventory is gone, then they can't do it a second time. And so people will, in many respects, that's what I meant. They could push it to 80 for a few months, and then it would start going, and then it would start trending back, and then it would rip back to where it was at before. So you'd have to just be patient and wait for it to come back. But if you own silver miners, your silver miners could drop 50% in a week. And a lot of people can't handle that volatility. So the volatility in the miners is going to be silver is going to be very extreme, but ultimately it's going to go much higher. The key here is gold. Gold, it's how long this bull market, does it last 2 years, 3 years, 4 years? We don't know. I think it'll last at least 2 more years. And the longer that the bull market in gold lasts, the better for silver. It's very basic, very simple. So my targets are 7,000 gold and $200 silver. Now, why? So I think $7,000 gold, if you look at the technicals, if you look at history, I think 7,000 absolutely is a very achievable level. And I actually think we probably will go significantly north of that. But I think that's a very conservative target. I mean, we were just at 5,600. So 6,000 is just way too low, right? So I think 7,000 is a legitimate number right now. Now, if you use 1% of gold, that takes you to $70 silver. Well, that's way too low. 1% is just ridiculous. We were at 3.5 in 2011. So if you go 2%, it's 140, and if you do 3%, it's 210. So I think it'll be somewhere between 2 and 3, and it could go to 4, which would be 280. But I think it'll be somewhere between 170 and 200 is kind of where I think it'll go. But it'll probably overshoot that and then come back down in that range, and then we could see periods of significant corrections that are much, much lower than those levels. I think it'll stay above 1%, but definitely. So that's kind of where I'm at with silver, a kind of a $200 target. I plan to sell all my miners somewhere between $6,800 gold and $7,800 gold. I do not expect to own any miners at $8,000 gold. And the reason why is two reasons. One, I got in early so I can leave early. And the second one is you don't want to sell tops. You don't want to wait for tops because you just don't know when they're going to come. And when they come fast and furious. So, at $7,200, $7,300 gold, I'll have sold probably half of my stuff.
That gives me a good idea of how you're looking at silver and the mining stocks as well. And on the note of the mining stocks, I know you're always looking for the companies with high potential, the 10 baggers or more. So I wonder how you're approaching the sector right now. I know you own many, many mining stocks, but where are you seeing those high potential companies at the moment?
Yeah, so I own 165 stocks, and I have 2 more 10 baggers that I'm going to buy here very soon. Now, so what I've done, I've been doing this for 20 years. For me, it's a trade. I'm not an investor. I'm a speculator. I'm a speculator on the U.S. government bond market, basically breaking down, which I think is a fait accompli. And so I'm waiting for that outcome. And so I'm trading for it. And so what I've been doing, I just keep collecting stocks. Now, since I'm doing this on a long-term basis and I don't know the timing of it, the way that I did, in my book, I wrote that I use a pyramid approach. So I create a foundation, and the foundation has to hold up all of these highly risky big alpha stocks. And so I own physical silver, and then I own 7 ETFs. So there's only 4 silver miner ETFs: SIL, SILJ, SLVR, SLVP. So I own those 4, and then I own 3 gold miner ETFs: GDXJ, GOAU, and SG. It's the Sprott one. SJ. I can't think of it. SG or SJ, but it's the Sprott midterm. So I own 7, and then I own 3 gold miner mutual funds. And then I own some majors on top of that. And then I own a lot of quality mid-tiers on top of that. So that's my foundation. So I create a really, really strong foundation, and then I go for it. I start buying 10 baggers, all these stocks that are, very high risk. And and those are the only ones I'm interested in. And so, but I avoid exploration unless it's a really good optionality play. But I focus on undervalued junior producers, and then if I can find undervalued a major, but you can't find any of those anymore. But you could until recently. When I say undervalued, I mean 5 bagger plus. Although I did buy some Northern Star recently because it got really, really cheap. They're a major in Australia, and now I'm looking mid tiers. I can find some mid tiers. There's still a lot of mid tiers out there that are 10 baggers, and then developers. And so, like, one of the stocks I'm going to buy is a producer mid-tier, and the other one is a developer. So I'm looking for 10 baggers. Those are the only stocks I'll buy. And so I'm just about done. But it's amazing. These stocks are still cheap right now. But if I find 10 baggers, I will do it. I actually found, this is absolutely insane, but I actually found a potential 250 bagger, which is absolutely nuts. But it's no longer 250 bagger, but Lahontan Gold was trading at, I don't know, 7, 8, 9 cents. And Victoria Gold owned 30% of the company. And Victoria Gold went bankrupt. And so they had a market cap of like $10 million, something like that. But Victoria had to sell a third of it. So everybody knew this because Victoria's bankrupt. So when they're bankrupt, they have to sell all their shares. They have to raise the cash. They can't hold them. That's the way it works. So the stock just, all it did was just trend lower and lower and lower and lower, right? And I didn't own it. And I'm like, because I don't really like small gold projects, but they had almost a big one. I mean, at one point, I don't know, I think at the time, I don't know if it was 1.5 or 1.9 million ounces, but it was a development play in Nevada. And I was watching it. It kept going down, down, down. I'm like, holy crap. This thing is just, it was totally mispriced because nobody would buy it because they knew Victoria's just going to keep selling and selling. And so no one would touch it with a 10-foot pole. It went all the way down to 2 cents. That's where I bought it. I bought it it was the very bottom. I bought it at 2 cents. So my target right now, today, for Lahontan is $5. That's a 250 bagger. That's absolutely insane. $1 is a 50 bagger. $1, right? It's already at 30 cents. So, but I mean, that's the kind of upside you can get. You can find 50, 100, but 250 baggers. I mean, those are pretty rare. But my target right now is $5. All they have to do is get into production, which will take a couple years. And then they got to build their mine, get into production. Don't dilute us too severely when they build the mine. And then get their production to 70,000 ounces a year. They're at one point, they're over. They're about they've grown their resources, about 2.5 million ounces with their recent drilling. So they should easily be able to get to my 70,000 ounce a year target. And so, I mean, it's still super cheap. My target is $5 and it's trading about 30 cents. But I just wanted to give people an idea of the kind of leverage that's out there. But there's 10 baggers all still to this day all over the place. As a matter of fact, just about every silver producer is five plus bagger right now. Every single one of them. Which is kind of insane that you can say that. With silver at $79 and they're all 5 plus baggers. Now, this is it. Again, I'm a speculator. When I say the Lahontan is going to go to $5, that's at $7,000 gold. Now, most people are like, Don, you're absolutely nuts. We're not going to $7,000 gold. Maybe we won't, but I can speculate that we are. And that's what I do. I'm just going to, it's basically gambling. I'm going to gamble that gold goes to 7,000. So if it does, then these type of returns are kind of there. That's why I say there's like 10 baggers all over the place. That's at $7,000 gold and $200 silver. I really don't care about the current gold and silver price. I look at a company's current market cap and I compare it to their estimated future market cap.
Yeah, I think that makes a lot of sense. And that's what I was trying to get a sense of in terms of those 10 baggers. Where can you still find them? And it sounds like they are kind of still up and down the food chain to an extent for gold and silver. Sorry about my siren.
They're all 10 baggers. It's unbelievable. I mean, the only ones that aren't, I think Hecla and First Majestic, Pan American, but Pan American's probably 7, 8 bagger. But is in the silver world, they're pretty much all 10 baggers. Those are the elite silver producers. So once you go down the food chain just a tiny little bit, they're all 10 baggers. A lot of companies that have a lot more upside than that. A lot more. Tons and tons of leverage right now. I don't know how much longer it's going to last. Until Hecla gets to like $50. So Hecla's at $20 right now. It needs to rise 60% to get back to its all-time high that they had in January. Investors sold it off and just said, I don't want to own this thing. And it went all the way down to, I don't know how low it got, maybe 16, $17. Now it's at 1969, call it $20, and it needs to go to 32. Newmont was at 132 and it's back to 119. So it's only got 11% to get back to an all-time high. Coeur Mining, it was at $27 and it's at 21. It needs to rise 28% to get back to an all-time high.
Wow. And it sounds like we're going to get there eventually, perhaps sooner than later. I think we've got a good idea of your economic outlook, what you're approaching in terms of the gold and silver stocks. Any final thoughts you would leave investors with right now? I know we talked in January. I'm taking this as our mid-year conversation. Hopefully we'll see you again before the end of the year. But until then, what are you going to be watching most closely?
Yeah, after this is over, we'll schedule something. So for me, the one thing that you really need to focus on here is I feel like I'm talking my book, is that you need we're in a situation, I believe firmly, that gold and silver are really one of the best places for protection. If we are going to get into a problem economically, for instance, if what I'm saying happens with regard to the bond market breaking down, that means that I think they'll do a reset of some type. And if they do a reset, I think the low-hanging fruit, the easiest way to do a reset is to go all digital and do the CBDC and force everybody to turn in their paper dollars, and they basically get rid of the old US dollar. So the US dollar goes bye-bye. They introduce a new digital dollar, and they orphan off all those international dollars, the euro dollar, which is a big mess. They basically orphan all the euro dollars and say, those are yours, have fun. And they just go all digital. And if they do that, it's the easy way to devalue the dollar. So you'll wake up one morning and they'll make the announcement, and your dollars are basically, you're going to get rug pulled. They'll be down 30%. Overnight. But the one thing that's going to happen, that day that they make that announcement, gold will rise 30%. Silver will rise 30%. So if you don't own any gold and silver, you'll go, man, I wish I would own some gold. I just lost 30% of my bank account. So keep that in it, and that's a possibility. Thanks for having me on, Charlotte.
Of course. Always good to catch up with you. Thank you so much for coming on. And once again, I'm Charlotte McLeod with investingnews.com, and this is Don Durrett with goldstockdata.com.
Thank you for watching. If you like this video, make sure you hit the like button and subscribe to our channel. We'd also love to hear your thoughts, so leave us a comment below.